Have you heard of the book, The Little Book of Common Sense Investing by John C. Bogle? John Bogle is an American investor and the founder of the Vanguard Group. With the concept in his book, he has helped millions of investors achieve financial freedom. Hey buddies, welcome back. Today we are going to talk about The Little Book of Common Sense Investing by John C. Bogle. This book is amazing when it comes to personal finance and making smart investment choices. So, if you have been wondering how to navigate the world of mutual funds and make the most out of your hard-earned money, you are at the right place. So let's get started. Mutual funds are like mixed salad, but none of them are created equal. One of the best ways to invest sensibly is by choosing a low-cost, diverse fund that tracks the overall market. And that's where index funds comes to play. In the book, he talks about a few key ideas, where each of them helps to guide us in how to invest wisely. Let's understand the fact that the active managed funds are expensive and often underperform the market. They come with hefty fees, brokerage commission, and other costs that eat away your profit. In the long run, they may not yield as much as a low-cost index fund. In fact, statistics shows that by investing in an active fund rather than an index fund, you will probably walk away with 70% less in the long term due to fees alone. Most actively managed funds don't perform as well as you might hope, and even those few that have performed well in the past may not continue to do so in the future. It is like gambling with a horse race. Past winners may not guarantee future victories. So why pay high fees for uncertain outcomes? Many investors underestimate the true cost of active managed funds. They boast about high returns, but they forgot to mention the hefty fees that can significantly reduce your actual earnings. Moreover, emotions and the market trends often drive people to make unsound investment decisions, especially when everyone seems to be flocking to the same funds. So, what's the solution? Simply put the majority of your assets in a safe, low-cost index fund. These funds are designed to track the performance of the overall stock market, which means you are not betting on individual stocks. By holding a diverse portfolio over the long term, you minimize costs and increase your chances of getting a solid returns. But not all index funds are created equal either. And when doubt, you should always choose the cheapest index fund. Expense can really add up over time, so opt for a fund with a low-cost structure. Remember, the expense ratio doesn't necessarily reflect the fund performance. Finally, be very cautious of new investing trends. With so many index funds competing in the market, there's always new trends promising higher rewards, higher returns. But you should know that it's tough to predict which trends will be successful. So sticking to a fund with a proven track record at a low cost is a wiser move. So to sum up, opt for a low-cost, diverse index fund for the majority of your investment. And if you want to take a little risk or try your luck with an active managed fund, allocate only a small portion of your portfolio. Say no more than 5 to 15% depending on your risk profile. Remember, investing is a journey and it's essential to approach it with a common sense and a long-term perspective. By following the advice from the Little Book of Common Sense Investing, you can make smarter financial decisions and increase your chance of achieving your investment goals. Now, if you find this video helpful and want to see more videos like this, don't forget to give it a thumbs up and subscribe to our channel. So, are you ready to grow your income? See you on our next video.